the road ahead for this bull market. Let's welcome in our panel for some answers. Trivariate's Adam Parker, New Edge Wealth's Cameron Dawson, and Requisite Capital's Bryn Talkington. Both Adam and Bryn are CNBC contributors. It's great to have everybody with us. As I said, Bryn, we are heading for another record close on the S&P 500. How do you feel about things as this end of year approaches? We're going to put another great year in for stocks, and we look ahead to a new one.
Yeah, I mean, who would have thought back in the dark days of April that we would be where we are today? So I think investors who sat still through that period of time have been rewarded. And I think going into next year, I mean, we still have strong earnings, not only in the 493, but also in the Mag 7. I think rates are coming down a little bit more. Globally, things are doing well. And so I think unless we get an exogenous event like the Supreme Court saying we can't do tariffs, which would be a mess, we'll say, to undo that, I think we will have some volatility next year, but it looks like you have to stay invested and buy risk.
Okay. I mean, that's a pretty clear story. Adam Parker, does it make sense?
Yeah. Hi, guys. Great to see everyone. Yeah, look, I think growth is going to be pretty good. And I think, like Bryn pointed out, the gigacap stocks, the trillion and above club, they're all going to grow pretty strongly. So if you're negative, I think it comes down to maybe a view that the multiples can't expand much. And I think next year is going to be that transition in my mind where we saw a lot of multiple expansion previously, and now we need to see the earnings come through. So I don't think there'll be quite as much upside as we've seen the last 3 years, but I still think the risk reward is skewed to the positive for equities.
Does it have to, Adam, be an exogenous event that wrecks the bull story? That's the picture that Bryn paints. What do you think?
I don't know if it has to be exogenous. I think the issue, I guess I feel like the Fed part's a little wobblier than I did a year ago. Look, I mean, we've talked about it before, but the poly market and the probabilities sort of look like maybe they're going to cut one more time. I think most people I talk to think it'll be 2 or 3 more. But no matter what, they're kind of closer to being done than not on the front end. So I think the argument really comes down to, will multiples continue to be supported because of balance sheet expansion or because of fiscal stimulus or tax stuff? All that's pretty well, but on the multiple side. Yeah, I think about the market as price to earnings, ratio times the earnings. So I think the growth side looks pretty good. That's why we're up today, GDP, et cetera. I think you'll see productivity from AI. I think the multiple side's trickier. That's why I think there's a little bit less upside for the overall market.
Cameron, is the story pretty clean as we go into 26?
Well, I think that the multiple side of things is very important because that was very clear as we look at where we started this year at about 22.5 times forward, and we're ending this year at about 22.5 times forward. So it's all been driven, at least for this S&P 500, by this earnings growth. And there is high expectations for earnings growth going into 2026. If you break down consensus, it's sitting at about 14% growth for next year. And it has 200 basis points of margin expansion already baked in, as well as an acceleration of revenue growth. So it's not something that we necessarily want to bet against. We are optimistic that there's going to be efficiency gains in this economy, but to argue that the bar is low is really hard to do. So we think how this translates is that when you have a high bar for expectations and high valuations, it just makes you more susceptible to volatility as you move through the year, simply because there's less room to absorb those kinds of exogenous shocks.